Ever wonder why Jeff Bezos, Elon Musk, and private equity titans skate on taxes while you're paying up to 37% on your paycheck? Spoiler, this isn't a bug, it's cheat codes worth hundreds of millions. These are legal exploits built into the tax code 3 game-breaking moves: buy, borrow, die, carried interest, and the offshore shell game. And yes, they actually work. Soon we'll crack open each loophole, show exactly why you can use them, and then share the real legal tricks you can use to level up your own tax game.
Alright.
The first loophole is known as buy, borrow, die, and it's the ultimate billionaire play. It starts when someone purchases a fast appreciating asset, say shares of Tesla or a multi-million-dollar property, instead of relying on income that gets immediately taxed. The trick, rather than sell and pay capital gains, they borrow against the asset loans aren't taxed as income and use the proceeds to spend freely. Over time, that asset may balloon in value. Remember, the loan didn't touch its growth, but they never realized the gain, so no tax is triggered. Then comes the final step, die. Upon death, heirs inherit the asset with a fresh stepped-up basis, resetting the tax cost to the market value at that moment. So when heirs cash out, it's like the original gain never existed. No capital gains anywhere to be taxed. It's a 3-part legal hack that lets billionaires enjoy cash flow while locking in massive wealth transfers, tax-free over generations. That said, this isn't some middle-class magic trick. To pull it off, you need colossal assets enough to score loans at low interest rates, often up to 90% of value, and you need a sophisticated setup, securities-backed lending or jumbo HELOCs, that ordinary investors simply can't access, plus world-class legal and tax teams to navigate the structures. Attempting this without the scale and infrastructure, you'll face huge risk, missed loan payments, and the bank forecloses. Stepped-up basis repeal and excise taxes on large SBLOCs are also gaining political heat, threatening the loophole's future. Simply put, buy, borrow, die is the billionaire cheat code, not something Joe Sixpack can ever use.
Alright.
Next cheat code is carried interest, another billionaire level exploit. At its core, carried interest lets hedge fund and private equity managers take their performance fees, typically around 20% of a fund's profits, as long-term capital gains instead of ordinary income. Since long-term gains are taxed at 20% plus 3.8% investment tax, instead of up to 37%. This loophole delivers a huge tax break. Put simply, fund managers earn what is effectively salary or bonus, but the IRS treats it as investment gains. The standard fund structure charges a 2% annual management fee taxed as ordinary income, and a 20% carry on profits once a minimum return is met. That carry isn't taxed until profits are realized, and because many funds hold investments for 3 or more years, managers almost always benefit from the favorable capital gains rate. A notable policy tweak in 2017 lengthened the holding period to 3 years, a modest tightening but didn't change the fundamental loophole. Critics argue that this is unfair. It classifies labor income as capital gains, costing the US Treasury billions. The Bipartisan Congressional Budget Office estimates that treating carried interest as ordinary income could raise around $13 to $14 billion over 10 years. Attempts to close or limit this loophole date back to 2007 under Sen. Carl Levin, and were revived in recent proposals by Trump, Biden, and congressional Democrats, but strong lobbying has consistently blocked meaningful reform. Still, this cheat remains exclusive. To use it, you'd need to be running a private investment fund, manage massive capital, navigate complex legal structures, meet required holding periods, and survive fund waterfall hurdles. This isn't accessible to everyday folk or retail investors. It's a giant step beyond what your average 401k can touch. And as long as the loophole persists, fund managers will keep getting that sweet double-digit tax discount on 7-figure payouts.
Alright.
Now that we've unpacked carried interest's golden loophole, let's move into the murky waters of offshore trusts, shell companies, and global profit routing. Wealthy individuals and corporations set up trusts in low or no tax jurisdictions like the Cook Islands, Nevis, or the Cayman Islands, often controlled by opaque shell companies. These structures charge income to foreign entities and siphon profits overseas, where reporting burdens are minimal, while still accessing and benefiting from the money in wealthy nations. Multinational firms use tactics such as the double Irish plus Dutch sandwich to shuttle intellectual property profits through Ireland and the Netherlands and into zero tax havens, reducing global tax bills on hundreds of billions of dollars each year. The OECD estimates these tools allow corporations to shift $100 to $240 billion annually in profits that should have been taxed elsewhere. A single corporate strategy, at the largest scale, the so-called largest BEPS transaction in history, involved US tech giants moving over $300 billion offshore in one swoop. On the individual side, elite tax planners abuse similar structures, offshore trusts, shell companies, and hybrid entities to conceal passive income like interest, dividends, and capital gains. Even with improved transparency frameworks like FATCA and the Common Reporting Standard, the ultra-rich remain adept at exploiting loopholes. Estimates suggest nearly 25% of offshore financial wealth still evades taxation. But here is the catch: setting up and managing these offshore schemes requires vast resources, legal teams, international coordination, and infrastructure beyond what ordinary people or small businesses could support. Without the capital, connections, and complexity, you simply won't qualify. In essence, this cheat isn't just hidden, it's locked behind a bespoke fortress that only the ultra-wealthy can penetrate. Now we've dissected the major billionaire loopholes. Let's zoom out.
Alright.
Despite how appealing these loopholes may seem, they are completely out of reach for most people. For starters, to borrow against assets at favorable terms, lenders typically demand tens to hundreds of millions in holdings and impeccable credit. Ordinary investors simply don't qualify. Private equity fund structures that redeem carried interest involve forming special partnerships, raising investor capital, meeting hurdle rates, and enduring multi-year campaigns. This isn't something you do in a Robinhood account. Offshore networks require specialized international legal teams, trustees, and constant compliance with complex global tax regimes. Just setting one up can cost tens of thousands, with annual maintenance and audit risks. Furthermore, policymakers are well aware of these advantages and are increasingly moving to close the gaps. Proposals range from applying excise taxes or deemed realization on large loans to overturning step-up basis rules. Each would heavily curtail or eliminate buy, borrow, die. For carried interest, bipartisan legislation has long sought to reclassify it as ordinary income, though powerful lobbying still hampers reform. And offshore trusts face mounting global scrutiny, stricter disclosure mandates, and legislative knockdowns like the UK 2025 trust reforms. In short-scale complexity and political protection, lock these loopholes behind a velvet rope. You'd need fund-level capital, multi-million-dollar portfolios, and world-class legal teams, not to mention confident regulators to even attempt one. These aren't accessible hacks, they're elite wealth tools. And until major structural reform happens, they'll remain firmly out of reach for the rest of us.
All right.
Now that we have laid out the billionaire-only cheat codes and explained why you can't use them, here are practical legal strategies you can use to optimize your taxes and keep more income in your pocket. First up, maximize contributions to tax-advantaged retirement accounts. In 2025, the limit for 401k, 403b, and 457 plans has increased to 23,500 plus 7,500 catch-up contribution for those 50 to 59, and up to 11,250 for those 60 to 63 under Secure 2.0. Traditional IRA limits sit at $7,000 or $8,000 for those over 50. These pre-tax contributions lower your taxable income now, letting your money compound tax deferred, and if you switch to or use a Roth option, withdrawals can be tax-free in retirement. Next, don't overlook the health savings account, a rare triple tax advantage tool. If you're enrolled in a high deductible health plan, you can contribute up to $4,300 self-only or $8,550, family plus a $1,000 catch-up, if 55 plus in 2025. Contributions are tax deductible, grow tax-free, and withdrawals for qualified medical expenses are also tax-free. And unlike FSA, unused funds roll over and can be spent in retirement. Another powerful move, tax loss harvesting. This strategy lets you sell underperforming assets to offset gains up to $3,000 a year in ordinary income, with any excess carried forward. By using losses to neutralize gains, you reduce tax liabilities while maintaining your investment strategy. Robo-advisors like Wealthfront, Betterment, and Schwab Intelligent Portfolios can automate this process, maximizing tax efficiency without requiring you to micromanage. Consider asset location optimization. Hold tax inefficient assets like bonds or REITs in tax-deferred accounts, 401k and IRA, while keeping tax-efficient investments like index funds in taxable accounts. This minimizes taxes on interest and dividends. Don't forget charitable giving with donated appreciated stock by gifting stocks held over a year to a charity or donor-advised fund. You avoid capital gains tax and deduct the full fair market value, helpful for reducing taxable income while supporting causes you care about. Other valuable steps include defer income when possible, accelerate deductions into higher tax years, optimize payroll contributions to HSA and FSA, and stay organized year-round, track receipts, donations, and business expenses to ensure nothing slips through come tax time. We've explored the secret billionaire loopholes and why they're out of reach. Now you've got real effective tools that you can put to use without needing a hedge fund or offshore empire. Thanks for watching, adventurers. If you picked up any new XP or just enjoyed the loot run, smash that like, subscribe, and ring the bell to stay on the leaderboard. But a wild tax trick you've heard whispered in the guild hall, drop it in the comments, or tell me which hack I should expose next. Until next time, keep grinding, keep optimizing, and keep leveling up.